Hey everyone, welcome back to Conviction Bet. Hope you're doing well. It has been a wild week to own chip stocks. South Korea's chip-heavy market fell almost 10% in a single session, its worst day in months. And the Philadelphia Semiconductor Index dropped nearly 8% here at home as investors yanked profits out of one of the hottest trades of the year. Then Micron and Qualcomm put up strong numbers, and the whole thing came roaring back. And speaking of money crowding into one story, right up until it cracks. For about 48 hours this week, the hottest corner of the market gave everyone a live reminder of what happens when too many people pile into the thing that already went up. Painful. Also, conveniently, the entire subject of today's episode. But here's what this week is really about. A few years ago, there was a fund. Over one 5-year stretch, it compounded at about 41% a year. One of the best performing US stock funds over that period. It beat the S&P 500 by more than 15 points a year. And the average dollar invested in it earned about 10. The market wants to tell you a story about which fund you should have picked. The real story is the gap between what a fund earns and what the people who own it actually take home. And that gap has your name on it. I'm J.L. Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. I'm going to show you a number that almost no brokerage statement puts in front of you the difference between what your funds earn and what you earn and why. In one of the best funds of the last decade, the people who owned it kept a fraction of its return. And then I'm going to do something most people telling you this story refuse to do. I'm going to argue that most of that famous gap might not be your fault at all. Let's start with the number itself. Every year, the research firm Morningstar publishes a study with a title I love. It's called Mind the Gap. And here is what their latest one found. Over the 10 years through the end of 2024, the average American fund returned about 8.2% a year. But the average dollar invested in those same funds earned about 7%. That is a gap of about 1.2 percentage points a year. Doesn't sound like much. It's roughly 15% of the total return gone. And it came from the timing and the size of the money going in and out when dollars entered the funds and when they left. People call it a behavior gap, though, as we'll see in a minute, it's a messier number than that name suggests. This is the thing behind that old line you've heard 100 times. The fund makes money, but the people in the fund somehow don't. And it isn't an American quirk. Morningstar runs the same study across the developed world, Britain, Australia, Europe, and the gap shows up almost everywhere they look. A separate body of work, going back decades, finds the same thing in the US. Which tells you something. Whatever is causing it, it shows up across markets. So it isn't that American investors are uniquely foolish. Some of it is surely human behavior. And some of it, as we're about to see, may just be the arithmetic of when dollars happen to flow into a rising fund. Now, here's the cleanest way I know to feel that difference. Picture a bus. The bus drives a fixed route, same traffic, same potholes, same open highway, the same start and the same finish. And at the end of the day, the bus has one average speed for the whole trip. That average speed is the fund's return, the number on the brochure. But your speed depends on which stretches you are actually on the bus for. If you hop off in the traffic jam, climb back on once the road opens up, then jump off again the second it gets bumpy, your personal average can end up far below the bus's, even though you rode the exact same road. The fund's return is the bus. Your return is you getting on and off. And all that getting on and off is one way the gap can open up. But hold on to a caveat here, because it matters. That aggregate number doesn't tell us how much came from genuinely bad decisions and how much came from the plain mechanics of cash flows. We'll separate those in just a minute. So here's the first thing to understand. Picking the right fund might be the second decision that matters. The first one is whether you can sit still on the bus. Think about what that means in real life. Two people, same fund, same 5 years. One of them buys in, and then through every scary headline, every red day, every breathless, this time is different, does absolutely nothing. The other watches the news, gets out when it's frightening, climbs back in when it feels safe again. Same funds. The first one roughly earns the fund's return. The second earns the gap, which is to say, a good deal less. And the difference between them was never intelligence or information or a better stock. It was stillness. Now, here's where I have to be honest with you, because most people who tell this story are not, most people stop right there. They take that gap, multiply it across every investor in America, and tell you it's all your bad behavior, your panic, your greed, your terrible timing. And I'm not sure that's true. This year, a paper in the Financial Analyst Journal by a finance professor named Fulkerson and 3 co-authors took the same data apart. And they argued that most of that gap is not bad decisions at all. It's arithmetic. Think about it. When a fund grows over time, more dollars are naturally invested near the end than at the beginning. That's just what growth does. And the math that produces the gap treats all those late dollars as a penalty, even when nobody did a single thing wrong. Their estimate for the part that's genuinely bad timing, about 1/10 of a percentage point a year. Carefully. So I want to be precise here because this is the part that matters. The gap is real. The arithmetic is real. But how much of it is actually avoidable? How much is you being your own worst enemy versus just the shape of how money flows into a rising fund is a much smaller and much more honest number than the headline. So if anyone ever tells you you're bleeding 15% of your returns through sheer panic, be skeptical. The leak is real. But at the aggregate level, the avoidable part is closer to a trickle than that headline suggests, and that changes what you should actually do about it. But there are places where the trickle becomes a flood, and they are completely predictable. The first is chasing performance, buying the fund that just topped the charts. And I want to give you the single most damning statistic I know on this. S&P keeps a scorecard tracking whether last year's best funds stay the best. And of every American stock fund that ranked in the top quarter at the end of 2020, the number that were still in the top quarter 4 years later by the end of 2024 was 0, not a handful, 0. Loosen the bar all the way down to the top half, and the repeat rate still comes in worse than a coin flip. And think about why chasing is so seductive. There are about a dozen big sectors in the market, and every year a different one wins. One year it's consumer stocks, then healthcare, then energy, then whatever has the letters AI in the name. The leadership rotates, almost at random, and the odds that the same narrow slice leads 3 years running are tiny. But the human brain sees one spectacular year and immediately writes a story. This is the future. So you buy right at the top of the rotation. There's an old line that judging a fund by its recent past is like driving a car by staring into the rearview mirror. It works beautifully, right up until the road turns. And here's the part that should genuinely bother you. This is getting worse, not better, because now it's engineered. A few years ago, regulators up in Canada ran a clean little experiment. They gave people a simulated trading account, and to one group, they handed out points, worthless points, no cash value at all, just for buying and selling. That group traded 39% more for confetti, and the more you trade, on average, the worse you do. So understand what your trading app actually is. Many of them are not neutral windows onto the markets. They're alerts, they're rewards, the little bursts of color. They are designed to make acting feel more natural than waiting. So the most natural instinct you have as an investor to buy what's working is the one the data punishes most reliably and the one your phone is quietly built to encourage. Now, the wilder the ride, the worse all of this gets. Morningstar found that the funds with the calmest, steadiest money flows lost about 0.8 of a point to the gap. The wildest ones, almost 2 full points. And here's the hopeful flip side of that, which almost nobody talks about. The boring all-in-one funds, the target date funds in most people's retirement plans, the ones that quietly rebalance themselves while you ignore them, those had basically no gap at all. In some cases, the people in them actually kept the whole return or beat it because the money went in automatically every payday in good markets and bad. The exciting stuff, the narrow sector funds, the thematic funds had the widest gaps of all, which brings me back to that fund from the top of the show, Cathie Wood's ARK Innovation Fund. And I want to tell you the timeline because it's almost perfectly designed to break a human being. Back in 2017, this fund returned 87% in a single year. And do you know how much money was in it for that run? About $116 million. Tiny, almost nobody. Then the headlines came and the money came with them. And by the middle of 2021, the fund had swelled to more than $25 billion. $25 billion, arriving right as the performance was about to roll over. So across the 5 years through late 2021, the fund compounded at about 41% a year, but the average dollar that was actually in it earned about 9.9. The great returns happened when the fund was a $100 million secret. The crowd showed up for the part that came after. And the part that came after was brutal. Over the 12 months ending in late 2021, that's Morningstar's measurement window, the average dollar took about a 12% loss, while the fund's own return for that same stretch was down only about 4%. Then 2022 arrived, and the fund fell by roughly 2/3. By the end of that year, those $25 billion had become about 6. Morningstar later added it all up. Over the decade through 2024, it estimated the ARK funds destroyed about $13.5 billion of investor wealth, more than any other fund family in its study, about twice the next worst. And not solely because the investment soured. Poor fund performance and badly timed money worked together. The gains came when almost no one was there, and the losses came after everyone had arrived. So a dazzling track record tells you what was possible. It does not tell you what anyone actually got. And the more thrilling the charts, the wider that gap tends to be. And if you want to see the setup forming live, look at the people who piled into chip stocks near the top of this year's run, right before this week's drop. It's the same temptation that pulled people into ARK in 2021. A spectacular recent return starts to feel like proof about the future. That doesn't mean the chip trade ends the same way. It just means the behavioral setup rhymes. Now, if you really want to turn the trickle into a flood add leverage, there's a whole category of funds that promise you double or triple the daily move of an index. And the word doing the damage there is daily. Here's the trap. In 2 days of arithmetic, say an index falls 10% one day, then rises about 11% the next, you are basically back where you started. But a fund geared to 3 times the daily move falls 30%, then rises 33%, and you land almost 7% in the hole on a round trip that went absolutely nowhere. That's not a fee. That's the math of resetting every single day. And in a choppy back and forth market, it can create real drag even when the index itself finishes roughly unchanged. So the tripwire isn't all leverage, always. It's daily reset leverage products that you don't fully understand, can't watch closely, or are quietly treating as a regular long-term holding. Those can magnify both the path dependence we just talked about and any behavioral mistakes you make on top of it, which is the part already costing you. Now, here's where it turns. Because so far, this has all been about what you lose. Let's talk about what you can actually win. There's a second number, and it has a name too. Back in 2013, 2 researchers at Morningstar, Blanchett, and Kaplan coined a term to sit right next to the famous ones, alpha and beta. They called it gamma. And gamma is not about beating the market. It's the value you create just by designing the rest of your financial life well. And the beautiful thing about it is that almost none of it requires you to be right about anything. You don't have to forecast the Fed or AI or the next sell-off. You just have to clean your own house. Think of it as a checklist of plain questions, and I want to walk a few of them because each one is a place money quietly leaks. The first one even comes before you invest a single dollar. Is there a better use for it? Because if you're carrying a credit card balance, and these days the average American card charges around 21%, then paying that off is a guaranteed saving equal to your card's rate, No stock is going to reliably beat that. The highest returning, lowest risk move most people can make isn't an investment at all. It's their own credit card statement. Same with an employer match in your retirement plan. That's an instant, guaranteed return. You simply cannot get anywhere else, even if you have to stick around a couple of years to fully earn it. People leave it on the table every single year. Then there's the question of how much risk is actually right for you. And I want to slow down here because there's an idea inside this that genuinely changed how I think about my own portfolio. Picture a 30-year-old with a stable job, a teacher, say, with a steady salary she'll earn for the next 30 years. That future salary is itself an asset. It pays her year after year, almost no matter what the stock market does. In other words, she is already holding an enormous, boring bond in human form, which means in her actual investment account, as long as that paycheck is steady and not riding on the same things her portfolio is, she can afford to own more stock than she'd guess. She's already got the ballast. Now, run it forward. At 65, that human bond is nearly spent. The salary is ending. The ability to just work a few more years, save a little more, and ride out a crash that's mostly gone. So the same person with the exact same temperament should usually be taking less risk at 65 than at 30. Not out of fear, but because the giant bond that used to back her up has been used up. Your portfolio isn't just your portfolio. It sits on top of your paycheck, and your paycheck is part of the picture. But that's the math of how much risk you can take. There's a second question no spreadsheet can answer: how much you can actually stand. I heard once about a guy, solid finances, plenty of capacity on paper, who decided he could handle an aggressive, volatile fund. 5% of his money, he figured, no big deal. Turns out the number on the screen and the feeling at 2 in the morning are two completely different things. He couldn't sleep. He bailed at the bottom. The capacity was real. The tolerance wasn't. And most people don't find out which is which until they're already in it. A couple more, quickly. Are you actually diversified, or do you just own 5 different flavors of the same bet? Because owning tech in healthcare, in financials, feels diversified right up until the market falls. And every one of them, being American stocks, falls together. Real diversification means owning things that don't all move the same way on the same day. Adding bonds, adding the rest of the world, things that zig when your stocks zag. They call it the only free lunch in finance because it's the rare case where you genuinely lower your risk without giving up much return. And for an ordinary investor, getting it right is worth real, repeatable money over time for doing nothing more than spreading out. Does the mix fit the goal? And here's a subtle one that most people get wrong, including me, for years. We picture retirement as a finish line, a big number you hit, and then you stop. But it isn't a lump sum. It's a 30-year paycheck you have to write to yourself every month, decades from now, and the price of everything you'll buy with it keeps climbing the entire time. So you can't just chase the highest average return. You need things whose income keeps pace with rising prices. A long nominal government bond is exposed to inflation, not protected from it. Its fixed payments lose ground when prices rise. The bonds actually built to track inflation are a different tool entirely. And finally, are you using cheap, simple vehicles instead of expensive, complicated ones? And do you rebalance on a rule? So a roaring bull market doesn't quietly turn your careful 60-40 into a reckless 70-30 you never actually chose. None of that is glamorous. All of it is in your control. So how much is it worth? The estimates vary, and this part matters. You cannot just stack them on top of each other. Blanchett and Kaplan put their original version at the equivalent of about 1.5 percentage points of return a year in a retirement model. Vanguard, in its own long-running study, puts the whole package of good advice at up to or even more than 3% a year. And the single biggest piece of it isn't a clever tax trick. It's behavioral coaching, just keeping people in their seats. Put those two facts side by side for a second. People will switch funds, chase managers, and trade all year long, hunting for a single extra point of return they almost never actually capture, while a couple of points of value sit right there in the plumbing of their own financial life. Not free, not guaranteed, but far more dependable than the trade they're chasing. We go looking for an edge in the one place it's hardest to find, and we ignore it in the one place it's nearly within reach. So, in Vanguard's own accounting, one of the biggest things a good advisor adds isn't stock picking, it's behavioral coaching, which mostly means talking a client out of a trade at the worst possible moment. The catch, and it's a real one, is that coaching yourself takes exactly the discipline whose absence makes the coaching worth paying for in the first place. So, if coaching yourself is hard, and it is, the real trick is to take yourself out of the loop entirely. Remember those boring all in one funds, the ones with almost no gap? That is not an accident. They rebalance on a schedule you never see. And in a lot of retirement plans, the money goes in automatically, out of every paycheck, whether the market is euphoric or terrified. Automation is just discipline. You only have to summon once. You make the good decision a single time in a calm moment, and then you let a machine repeat it for 30 years on all the days you'd have made a worse one. The goal isn't to become a person with superhuman willpower. It's to build a system that doesn't ask you to have any. So let me steel man this whole thing, because I've just spent half an hour telling you that behavior costs you money and I owe you the other side. And I know what the bear case is because I'm the one who gave it to you halfway through this episode. If most of that measured gap is just arithmetic, the shape of how money flows into a growing fund, not a record of bad decisions, then fixing your behavior recovers far less than the headlines promise. Maybe a tenth of a point, not a point and a half. That is a completely legitimate concern. And honestly, I think it's mostly right. But here's why the bigger thesis survives it anyway. Two things. First, the planning levers don't depend on the behavior math at all. Paying off a 21% card, grabbing the employer match, using the right account, keeping your costs low, rebalancing on a rule that's just arithmetic. It's real whether or not you ever panic sell a thing in your life. And second, look at the pattern. The boring autopiloted funds have almost no gap. The wild ones have the widest. That is exactly what you'd expect if behavior were doing at least some of the damage. It's not proof, but it's a pattern that is very hard to wave away. And notice the one thing every piece of this shares. None of it, not the debt, not the match, not the diversification, not the rule that keeps you in your seat. None of it requires you to be right about where the market goes next. That is what makes it the rarest thing in this whole business. An edge that doesn't depend on a forecast. So here's what I'd actually watch for in your own account. Concentrated bets you bought for the story instead of the math. Sector or thematic funds you don't have the conviction to hold through a 40% drawdown. Daily reset leverage products you're treating as long-term holdings. And quietly, the most corrosive of all, investing with no written plan so that every scary headline becomes a fresh decision and every decision is one more chance to leak. Look, there's an old idea in philosophy that the map is not the territory. Your portfolio is the map, the actual goal, the retirement, the house, the 30 years of income that has to keep up with the price of groceries that is the territory. And we spend almost all of our energy fighting about the map. Which funds, which sector, which AI name, and almost none on the territory, which was the only thing that ever mattered. Benjamin Graham, Warren Buffett's teacher, had a famous way of picturing all of this. He said, imagine you have a business partner named Mr. Market. Every single day, he shows up at your door and shouts a price at you, sometimes wildly high, sometimes absurdly low, depending entirely on his mood, which swings from euphoria to despair and back. And here's the key thing about Mr. Market. He does not mind being ignored. If you don't like today's number, you do nothing, and he comes back tomorrow with a new one. The whole game is to treat his mood swings as your opportunity, never your instruction. And what have we done? We've built a world, the apps, the feeds, the alerts that pipes Mr. Market's mood straight into your pocket all day long and begs you to act on every twitch of it. Which is why the same man, more than 70 years ago, also said the truest thing anyone has ever said about investing. The investor's chief problem, and even his worst enemy, is likely to be himself. So come back to the bus. The road outside is loud, and it is not yours to control. The Fed, the chip sell-off, the next crash, none of that is in your hands. But two things are, which bus you get on and whether you stay on it warmly. Choose the right bus, a diversified, low-cost plan that actually fits where you're trying to go. Tidy the balance sheet, kill the expensive debt, grab the free match the risk to the goal. Write the plan down, and then mostly just stay on it. And you will find under the furniture money you'd been quietly giving away for years without ever noticing. The quietest edge in investing isn't a better stock. It's choosing the right bus and then having the discipline to stop jumping off every time the road gets rough. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's Quiet Velocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.